One day in San Francisco, IRS officials were busy verifying the stock portfolio performance of this guy after he made a huge tax payment on his trading income. They wanted to know if the 29,223% profit that he made in a specific period of time was actually all of it or if there was more. The reason why these profits garnered so much attention is because they were not gained in 23 years or 13 years or something, but because they were actually gained in just 12 months. For context, this equates to 2,435% every single month, 121% every single day, and 5% every single hour. I recently did a poll asking you guys the average profit you make every month from trading, and the majority of you voted saying that you make less than 5% average per month. So I started to wonder, how did this trader make more profit in 1 hour than the average trader makes in a whole month? But more importantly, what strategy did he use? Well, in this video, we're gonna explore all of that. Let's get into it. Now, you may be asking yourself,
but who is this trader we're talking about? You've been calling him this guy since the beginning of the video. Oh, is he Guy from the movie Free Guy?
Well, no, he's not Guy from Free Guy. The trader we're talking about is the world record trader called Daniel Zanger, aka Dan Zanger. Dan is an American trader who profited immensely in the late 90s during the dot-com bubble. He's also the founder of chartpattern.com, a financial education and chart analysis website, and has also been featured in various financial media outlets. But perhaps what Dan Zanger is most known for is his successful track record as an investor and trader. Dan is claimed to have set a world record for the largest percentage increase in a personal stock portfolio in a single year. This, of course, happened when he gained a whopping 29,223% in just 12 months of trading. These huge gains allowed him to turn just $10,775 into $2.6 million in those 12 months. That $2.6 million then grew to $18 million in the next 6 months and subsequently to $42 million in the next 5 months. In short, he was able to turn just $10,775 into $42 million in a total of 23 months. Dan grew up in the San Fernando Valley of Los Angeles, California. He went to college but ended up dropping out to work as an independent contractor building swimming pools all around California. In 1997, Dan sold his car for $11,000 and deposited $10,775 into a stock trading account and started his trading career. He eventually stopped working as an independent contractor after making enough money from his initial investments. It's important to note that before making his fortune, Dan spent time studying the work of William O'Neill and later developed a preference for certain chart patterns such as the triangle patterns and the now famous flag pattern. Now, during the late 90s, the internet revolution was gaining momentum and it had a major impact on the global economy. More and more companies were using the internet to transform their businesses, and some companies even existed solely online. The US in particular experienced a major economic boom due to the success of these web-based or dot-com companies. Investors were super excited about this new internet industry, and the stock prices of these dot-com companies soared to the sky. Dan focused heavily on these explosive tech companies, especially those that exhibited certain types of chart patterns that he believed kept repeating themselves. He liked to look at the charts and identify stocks with his favorite chart patterns such as the triangle pattern and the flag pattern. Essentially, Dan looked for consolidation or sideways movement in prices and then waited for the price to break out of the consolidation range before entering any trades. Let's take a look at specific chart patterns that Dan used to find these explosive stocks. Here's the chart of a company called Internet Capital Group. The stock was just public after its IPO in August of 1999 and was trading at $30 a share. Dan noticed a small downward trend line forming and decided to take a position as soon as the price broke above the trend line. He then sold his positions when the stock's upward momentum had slowed down, so right here. A few weeks later, the stock formed a horizontal trend line, which prompted Dan to enter again after it broke above this trend line. The stock continued to rise until reaching over $190 a share and started losing its upward momentum, forcing Dan to sell all his positions. The stock consolidated for several weeks in what Dan referred to as a high-level symmetrical triangle. He entered a trade when it broke out of this pattern and then sold when there was a significant drop in upward momentum, right here. Now here's another example. This is the daily chart of Tesla dated February 5th, 2014. As you can see here, the price had a big bullish move that lasted several weeks and then pulled back into this consolidation and then created this bullish flag pattern. Dan drew a descending trend line, and as soon as price broke out of this consolidation, he bought the stock at the price of $153 a share. Several weeks later, after this explosive move, he sold his positions at 81% return. According to Dan, he took so many trades of this type during the 2-year period that it's not possible to remember all of them. He says it must have been at least 200 trades or more. All of Dan's chart patterns and trade setups can be found on his website, chartpattern.com. I'll leave a link in the description. On the website, you can see all the trade setups that he called out, starting way back in 1998 all the way to 2020. So essentially, Dan looks for this type of base formation patterns, flag patterns, triangle patterns, and enters into trades when price breaks out of these patterns and exits the trades when there is significant drop in volume or momentum. Now let's go on TradingView and see how I would trade with this strategy in a less subjective way. This is the daily chart of Tesla, and we're gonna add the volume indicator to it. To do that, type in volume on the indicators tab and click on this one right here. So here we can see that there is this setup that Dan usually calls a high-level symmetrical triangle that formed after this big bullish move that lasted several weeks. Following Dan's strategy, we will wait for the price to break out of this consolidation zone and also ensure that the volume is high enough to push the price in the direction of our trade. That is going to be indicated by this strong volume bar of the volume indicator. We're going to enter the trade as soon as the price starts breaking out of the consolidation phase, so right here. The stop loss is going to be set somewhere in the middle of this triangle, maybe right here. We're not going to set a take profit, we just let the trade run until the volume bars of the volume indicator start becoming shorter and shorter like here. Then we exit the trade on maybe this candle. We exit here because this drop in volume basically means that the market is starting to lose its upward momentum. For this particular trade, the risk-to-reward ratio would have been 1:8. You could of course sell maybe half of your positions and trail the rest according to your preferred method. Like most strategies we've covered on this channel before, this strategy really isn't groundbreaking. But the reason why Dan has been so successful with it is because of his 10 golden rules of trading. Here's a summary of the rules, I'm just gonna go over them real quick. Number 1, look for well-formed bases or patterns in the stock before buying. Number 2, buy the stock as it breaks above the trend line or the base pattern with high volume shortly after the breakout. Don't buy more than 5% above the trend line. Number 3, sell the stock quickly if it falls back under the breakout point by 5 to 7%. Number 4, sell 20 to 30% of your position if the stock moves up 15 to 20% from the breakout point. Here are the rest of them for you to read, but perhaps the most important of them all is number 10, which says, never go on margin until you've mastered the markets, charts, and your emotions. Margin can wipe you out. It's also important to note that Dan's success wasn't always a walk in the park. When asked about his biggest drawdown, Dan said, most drawdowns are about 20% in normal market corrections. Yet this long bear market really got to me and the drawdown was about 75%. My portfolio dropped about 32% for the day. It would have been much worse if I hadn't been allocated to a few other groups that day. So basically, Dan achieved enormous success during the dot-com boom by focusing on tech companies that displayed his most favorite types of breakout patterns. Now, I'm wondering, do you trade breakout strategies like Dan? Let us know in the comment section below. If you like this video, hit the like button below and consider subscribing to stay tuned. Thanks for watching and I'll see you guys next time.